On the sidelines of the G20 leaders meeting in Indonesia on Wednesday, the head of the World Trade Organization warned that several major economies were facing a real risk of sliding into a recession. The war in Ukraine, soaring food and fuel costs, and rising inflation were the factors she blamed. The effect of the global slowdown has now reached Indian shores. In October, the country's merchandise exports contracted for the first time in 2 years. The last time when exports saw a contraction was in November 2020. Slowing external demand against the backdrop of recession fears in the West impacted shipments from India. According to Commerce Secretary Sunil Barthwal, both global and domestic factors had an impact on India's exports. These included the tightening of monetary policy in Europe and the US, which slowed down consumption, and the impact of the festival season in India. Based on data from the last 2 years, Barthwal said there was a $4 billion gap in the trade between the pre-Diwali and Diwali periods. So, exports in November may perform better than in October, even though a full recovery will not materialize. Goods exports declined almost 17% in October to a shade below $30 billion. Imports moderated to their lowest level in 8 months. They grew at about 6% to almost $57 billion last month. This resulted in a trade deficit of about $27 billion, which remained above the $25 billion mark for a fifth straight month. The decline was spread across most segments. 24 of the 30 key export items saw a dip. Only 6 items, which are electronic goods, rice, tea, oilseeds, oil meals, and tobacco, witnessed growth. Key commodity groups such as engineering goods, gems and jewelry, chemicals, and ready-made garments saw double-digit contraction and dragged down overall exports. Non-petroleum, non-gems and jewelry exports, considered to be core exports, declined by 20% in October. Let us go into the details of key items. Engineering goods have been a mainstay of India's exports performance in recent years. Exports in this category dropped over 21%. According to the Commerce Ministry, the $2 billion drop included steel and its products. This indicates the impact of the export tax on iron and steel. India's iron ore exports reportedly slumped to nearly zero in October. A senior industry official also told media that overseas shipments were expected to continue languishing because of higher export taxes and lower demand from China. Ready-made garments and gems and jewelry, the country's key job-intensive sectors, saw exports drop over 21% from a year ago.
If you look at the drivers last year, and iron ore, for instance, iron ore and steel, these are the sectors which did the heavy lifting. Even agriculture, rice and wheat were really doing really well. Of course, rice is still expanding, but iron ore registered the sharpest decline among all the sectors, major sectors, in the 7 months or in October. Generally, engineering was doing very well. It did a lot of heavy lifting last year. Engineering is down in doldrums now.
Sharmila Kantha, principal consultant at CII, says that on the demand side, inflationary conditions and expected recessionary conditions in major economies seem to have impacted India's exports, particularly of discretionary items like garments and gems and jewelry. On the supply side, she said that the October export contraction can most likely be attributed to festivals during the month, when many factories operate at low capacity. According to Kantha, the machinery sector recorded a moderate growth in the previous month. So, a sharp decline in October is probably a deviation from the trend line. Kantha points out that continued strong growth in electronics is a heartening feature of the export profile and indicates the competitiveness of Indian manufacturers. Electronics goods exports grew almost 38% year-on-year in October to $1.8 billion.
In the global economy is cooling. And I was actually looking at the April to October numbers, and there you can see what is going on, because the April to October numbers, then the negative growth is seen in in only 10 out of the 30 sectors. So when the squeeze starts coming towards the end of this 7-month period, then you start, we start feeling the pinch. And again, we go back to the same old problem, that are we competitive enough, and has enough been done in terms of making our industry more competitive. And then, of course, questions have been asked about the PLI scheme, whether it's started paying dividends.
Madan Sabnavis, chief economist at Bank of Baroda, says that a slowdown bordering on a recession in the West will lead to a decrease in demand in general, which will affect India's exports growth. Therefore, he expects exports growth to slow down in the next few months and probably be negative. He adds that the exports of services like software will also be impacted by the recession, as demand for IT services will reduce. Hence, according to Sabnavis, both exports of goods and services will be impacted, thus affecting the current account deficit. He expects CAD to be in the range of 3 to 3.5% of GDP this year, notwithstanding an inflated denominator, as nominal GDP has been pushed up by high inflation. Actions on the domestic front are unlikely to affect the recession fears that have taken over across the globe. However, that doesn't mean that India should shy away from putting its own house in order. The country's foreign trade policy was last updated in 2015 and was supposed to last until 2020. Now, amid delays from the Commerce Ministry, Biswajit Dhar contends that a new comprehensive trade policy is overdue.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.